Many people believe the Federal Reserve only adjusts interest rates during its 8 annual scheduled meetings, complete with press briefings, Jerome Powell speaking, and news stories highlighting small increments like 0.25%. However, the crucial choices are actually made well in advance, through routine tweaks that seem unexciting, balance sheet maneuvers that rarely grab attention, and program launches tucked away in minor details. By the moment these rate shifts hit the front pages, financial markets have already adjusted. This isn't some hidden plot, it's simply the reality of contemporary monetary policy. On December 10, 2025, amid widespread focus on a 0.25% rate reduction, the Fed revealed an overlooked detail. From December 12th onward, it would acquire $40 billion worth of Treasury bills each month. They emphasized this wasn't quantitative easing but rather standard procedures to ensure sufficient reserves in the financial sector. The wording was intentionally bland, yet the consequences are profound, aligning with the same type of funding strains that signaled every significant economic disruption over the last 20 years. I'll break down the events and their significance, which eclipse the rate adjustment that dominated discussions. Altering incentives prompts shifts in actions, even without touching rates directly. From June 2022 onward, the Fed pursued quantitative tightening for 3 years, allowing its holdings to drop from $9 trillion to $6.5 trillion by December 2025. This meant $2.5 trillion in maturing assets weren't renewed, pulling that amount of reserves out of banks. The initiative wrapped up formally on December 1, 2025. Just 9 days afterward, the Fed pivoted, introducing a low-key plan to acquire $40 billion monthly in brief-term government bonds. As of January 7, 2026, the Fed's assets totaled $6.54 trillion, a sharp rise from roughly $800 billion back in December 2005. This growth, from about 6% to 21% of GDP across 2 decades, stemmed mainly from 2 bold strategies: bond buying programs amid the 2008 meltdown and further expansions during the pandemic. As the Fed aimed to return to standard practices, they encountered a challenge. The banking network struggles to operate effectively at existing reserve amounts. Short-term lending rates fluctuate wildly, government bond trading sees instability, and overall funding becomes erratic. The Fed terms this as hitting the threshold for ample reserves, which essentially indicates they've withdrawn excess liquidity and must now replenish some. This development is critical because the true policy trajectory is set long before public rate declarations. The October 2025 policy session flagged the end of asset reduction in December. The precise cutoff was December 1st, followed by the buying reveal on December 10th and rollout on December 12th. Every phase was handled discreetly, without alarm or urgency, simply as operational fine-tuning that conveniently supplies vast liquidity right as lending pressures emerge. Financial systems falter when cash vanishes, not when it's added. That's the overlooked dynamic. To illustrate, consider 2008 as a direct parallel. Discussions of that crisis often center on Lehman's collapse, plunging stocks, and rescue packages. But the Fed's pivotal moves weren't flashy reveals. They unfolded via obscure mechanisms unfamiliar to most. In March 2008, the primary dealer credit facility emerged, offering short-term loans to investment firms outside traditional banking. Announced on March 16, 2008, it aided Bear Stearns with $28.5 billion right away and ran until February 2010, peaking above $150 billion. Come September 2008, post-Lehman and amid money fund breakdowns, the asset-backed commercial paper money market mutual fund liquidity facility, AMLF, launched. It extended protected loans to banks for purchasing commercial paper from distressed funds. Usage topped $152 billion starting September 19, 2008 and ending February 1, 2010. Then in October, the commercial paper funding facility allowed a special entity to buy 3-month notes straight from companies, holding up to $350 billion at its height. These weren't minor fixes. They represented the biggest urgent liquidity injections ever by the Fed, with many specifics emerging only later. Freedom of Information requests and Dodd-Frank requirements eventually uncovered full details. Under Section 133 of the Federal Reserve Act, such urgent aid is permitted in extraordinary situations, reaching $710 billion at its 2008 peak. While some awareness existed, the complete extent, recipients, conditions surfaced afterward, prioritizing stability over immediate openness. Fast forward to now. The Fed avoids labeling this quantitative easing, opting for reserve management purchases to sidestep political backlash. QE implies economic boosting. This phrasing suggests mere maintenance. Yet the outcome mirrors it, growing assets, adding bank reserves, easing liquidity. At $40 billion monthly, a year's worth equals $480 billion. The Fed plans this intensity for months to offset expected reserve drains in April 2026, then tapering but persisting to keep reserves adequate. What prompted this turnaround? The overnight reverse repurchase agreement, on RRP facility, where funds and others deposit cash safely with the Fed. It once held over $2 trillion, but dwindled to almost nothing by September 2025 as rates climbed and assets shrank. This shift funneled money into alternatives like Treasury bills and repos, sparking volatility and squeezes. Reminiscent of the 2019 repo rate surge to 10%, which forced emergency interventions. The Fed learned from that. Endless reserve drainage invites trouble. There's a minimum for smooth operations, and they approached or crossed it, prompting the halt on December 1st and quick reversal. Actions speak louder than statements for the Fed. The purchase rollout confirms prior internal assessments of scarcity, likely identified weeks or months earlier. Preparations were underway, participants anticipated it, and markets shifted ahead of the formal notice. Consider the ripple effects. $40 billion monthly in bill buys hands cash to dealers and boosts bank deposits. System-wide liquidity rises, short-term rates ease, assets inflate, credit loosens, and risk-taking grows, all without rate tweaks. The balance sheet does the heavy lifting, explaining the non-QE framing, though it's inherently supportive. Looking ahead, after 3 years of slimming post-pandemic bloat, the Fed trimmed from $9 trillion to $6.5 trillion but hit a wall. Further cuts risk dysfunction. Thus, the baseline isn't the pre-2008 $800 billion, it's likely $6-7 trillion or more, around 20-25% of GDP, reflecting an evolved financial landscape. Most folks assume the Federal Reserve's biggest moves happen in the spotlight. Those 8 yearly meetings, the cameras rolling, Jerome Powell fielding questions, and headlines fixating on another 25 basis point tweak. But the truly consequential shifts occur far earlier in the quiet corridors of data analysis, internal modeling, and operational fine-tuning that rarely make waves. Rate announcements are often just the public reveal of choices already locked in. The real steering happens through seemingly mundane adjustments to reserves, balance sheet composition, and facilities that sound like footnotes. By the time the world notices, the financial system has long since adapted. Consider the deeper mechanics at play. Banks now carry higher reserve buffers because regulations demand it. Money market funds crave reliable, short-dated instruments for safety. The government's enormous Treasury issuance demands steady demand to avoid disruption. All of these forces require a central bank balance sheet substantial enough to absorb and support them. When that balance sheet remains structurally large, it delivers ongoing liquidity backing for asset values, not at crisis-era extremes, but well above anything seen in the pre-2008 world. Short-term and long-term rates face downward pressure from the Fed's persistent buying presence. Credit stays more accessible than it would under a leaner footprint, and when the next stress episode arrives, the starting point is already a bloated balance sheet, limiting how much further the Fed can expand before hitting practical ceilings. The ammunition for emergency response shrinks. Trace the sequence of events. Quantitative tightening kicked off in June 2022. By March 2025, the runoff pace was deliberately dialed back. October 2025 brought the official signal that shrinkage would cease. December 1, 2025, marked the formal end of the runoff. 9 days later, on December 10th, the Fed disclosed plans to start buying $40 billion in Treasury bills monthly, with operations launching December 12th. This wasn't a panicked firefight, it was a deliberate, pre-planned handoff. Staff economists tracking reserve trends, monitoring funding market friction, running scenarios, and briefing leadership until a pivot point was clear. The decision to halt the decline and begin replenishing reserves was finalized well ahead of the October heads-up. October set expectations, December delivered execution. The public sees it backward, announcement first, rationale later, perhaps in a white paper months down the line. Internal deliberations aren't cloak and dagger plots, they're standard central bank procedure. Economists crunch numbers, senior officials weigh options, models are tested, debates refined, wording polished, and logistics arranged. Only then does the policy step into the open. The core call, that reserves had fallen low enough and needed to rise, happened privately, weeks or months earlier. You might wonder why markets didn't freak out. They didn't, because fresh liquidity is welcomed, not feared. When the Fed adds reserves, risk appetite expands. The S&P 500 climbed, the dollar softened, Treasury yields generally drifted lower. Everyone recognized this as easing, different channel, same destination. More cash in the system fuels higher valuations and looser lending, no rate cut required. Early warning signs were there for anyone watching the right data. Overnight reverse repo balances slid towards zero throughout 2025, pushing cash into other corners. Repo rate swings grew more noticeable. The secured overnight financing rate showed subtle instability. Treasury bill supply began outpacing dealers' ability to intermediate smoothly. Fluctuations in the Treasury general account added chop. These are all public metrics, no insider access needed. They don't spell out the exact remedy or timing, but they scream that the Fed is observing identical pressures and has the toolkit to act. By January 7, 2026, the Fed's balance sheet read $654 trillion in total assets. Securities held outright stood at $627 trillion, split between $423 trillion in treasuries and $2.04 trillion in mortgage-backed securities. Notably, Treasury bill holdings jumped by $39 billion year-over-year, a clear marker of the new buying focus. Bills are the instrument of choice for reserve management. They suit money funds, stabilize short-term funding, and keep markets liquid. The public-facing framework stays unchanged. Dual mandate, maximum employment, and 2% inflation. Policy rate at 3.75% as of December 2025. The dot plot still penciled in one cut for 2026 and another in 2027. Powell talks about these in presses. They dominate news cycles. Meanwhile, balance sheet activity runs in parallel. Reserve purchases supply steady liquidity. The standing repo facility acts as a backstop against rate spikes. The discount window sits ready for banks in a pinch. These tools hum quietly, independent of the headline rate. What has shifted permanently is the baseline. The dream of returning to pre-crisis scale is over. $6.5 trillion isn't a midpoint on the way down, it's the new floor. Rate policy and balance sheet policy aren't isolated levers. They amplify each other. A big balance sheet paired with moderate rates equals meaningful accommodation. Shrink the balance sheet while keeping rates high, and conditions tighten aggressively. We're now in the former camp, sizable footprint, plus middling rates. Moderately supportive stance, headline number notwithstanding. Transparency doesn't mean real-time disclosure of every thought process. The Fed releases what it believes markets need to digest when it's ready. The analytical groundwork and internal consensus building remain private until the conclusion is firm. That's not deception, it's expectation management. Broadcasting every preliminary discussion would destabilize rather than guide. Key indicators to monitor going forward. Reserve balances. The Fed aims for levels somewhat above ample, likely $3.54 trillion. Weekly H4.1 reports reveal whether purchases are delivering or if more is needed. Repo market tension. Rising SOFR volatility or widening spread signal building strain. More purchases or standing repo usage would follow. Treasury bill issuance. With heavy supply, any demand shortfall pushes yields up and positions the Fed as buyer of last resort, already occurring under the surface. Standing repo facility activity. The Fed eliminated the $500 billion daily cap in December 2025, hinting at anticipated uptake. Regular use would flag private market liquidity shortfalls. Purchase pace itself, $40 billion monthly to start, sustained at elevated levels for several months, then tapering to a maintenance rate. If the taper never arrives or the pace rises, the ample threshold has proven higher than expected. The underlying truth is structural. Post-2008 regulation, post-COVID debt explosion, vastly larger money market fund sector, and overall financial system growth all demand more safe, liquid assets. The Fed supplies them via reserves and as a dependable Treasury purchaser. Shrinking back to 2005's $800 billion was never realistic in a system many times bigger. They tried, reached $6.5 trillion, and met friction. This is the settled state. The implications are lasting. A structurally larger central bank role in markets, interest rates lower than pure fundamentals would dictate, thanks to the Fed's standing bid. Credit conditions easier than a purely private system would allow. Asset prices higher due to built-in liquidity support. None of this is inherently virtuous or evil. It's the natural outcome of a heavily financialized economy with outsized public debt. The Fed maintains the pipes. The pipes simply need to be much wider now. What unfolded in late 2025 wasn't crisis response. It was proactive plumbing maintenance, adding liquidity before stress turned acute, reversing course just in time. Prevention rarely grabs headlines. There's no banner story proclaiming Fed quietly averts funding squeeze via routine bill purchases. Instead, attention stays on rate cuts while the balance sheet pivot does the heavier lifting. This is the essence of serious Fed watching. The decisive actions are administrative, technical, and deliberately low-key. They resemble routine maintenance for financial infrastructure, yet they dictate whether credit flows freely or freezes, whether markets hum or fracture, whether downturns remain manageable or spiral. Rate moves get the spotlight. Balance sheet operations deliver the substance. By the time they're broadly visible, informed participants, those tracking reserves, repo dynamics, bill auctions, have already positioned accordingly. December 10th, 2025, was one such marker. The $40 billion monthly Treasury bill program, dressed up as reserve management, is accommodation in practice. The balance sheet is growing again, liquidity is returning. Asset prices gain a backstop. Credit eases. None of it hinges on rate cuts. It hinges on grasping what the Fed is doing beneath the language. Master that distinction, and you see direction before the crowd. You catch signals in technical operations, while others wait for press conference soundbites. By then, the choice is already made. The trades are on, and markets have moved. That's not a bug in the system. That's how central banking operates in real time.